Alright, for this video we want to do a walkthrough of the Schedule SE for self-employment taxes, and this is going to be for the 2023 tax year. Now in this scenario, what we're going to have here is our taxpayer, John Q. Taxpayer. He is full-time employee at a software company, but he also has this side business where he does some marketing consulting. So he's got a Schedule C where he reports the income and loss from his marketing consulting business. But we can see here on page 1 of his 1040 that he's also got some W-2 income from this other business where he's a full-time employee. Now the reason why those details are significant is because when you complete the Schedule SE for your self-employment tax, you have to factor in how much Social Security tax you've already paid on other types of employee compensation or from other self-employed ventures. And so we'll have a look at Schedule SE for John and the rest of his 1040 and see how all this works together. So before we come back to that, just got one slide here covering some background on the Schedule SE and our self-employment taxes, and then some more details on the fact pattern. So Schedule SE used to report your self-employment tax and earnings. And the tax rates it's two components, right? So it's a combined 15.3% rate, which is 12.4% of Social Security, and that's on your combined earnings up to $160,200. Now this is the ceiling amount for the 2023 tax year. This amount changes from year to year, usually with inflation. So if you're looking at this in a future tax year or you're doing a previous one, you might have a different cap amount. So go check out specifically what limit applies to that year. But with the Medicare taxes, these are always just a flat 2.9% of whatever all your earnings are. So there's no dollar limit. Now, in this scenario where taxpayers have both employee wages and self-employment income, what are the things to be mindful of? Well, it's the Social Security limit is a big one. So Social Security limit is a combined limit on all of your compensation. And so that's why we have to look at both wages and self-employed earnings to figure out how much Social Security tax we pay. So let's have a look at the fact pattern and then the returns, and then hopefully this will make a bit more sense here. So we've got John Taxpayer. He's a software engineer, and he works full-time as an employee at a local software company. Now in his spare time, he also provides marketing consulting services, and he does this via a single-member disregarded LLC. And so that means all that activity is reported on Schedule C of his 1040. Now his W-2 from the software company shows Box 1 wages of $140K, and then his Box 3 and Box 5 wages $145. Now the $5,000 difference between those two, that's attributed to his deferred, his 401k pre-tax contributions, right? So 401k contributions are pre-tax, meaning they reduce your federal Box 1 wages, but you still have to include them in your wages for calculating Social Security and Medicare tax. And then his Schedule C is going to show profits from the business of $29,750. So when all this is thrown together, what we're going to see is the total amount of Social Security comp. So the $145 plus $27,474 of self-employed income, and the variance here, we'll talk about this when we get to the Schedule SE. But you notice that the total $172,474, it's above the $160 amount. And so this is where John has to be careful because he doesn't want to pay tax. He doesn't want to pay the Social Security tax on all of this. It's only the amount of tax on income up to this ceiling amount. All right, so let's have a look at the return here and try to piece all this together. So if we start with his Schedule C, we can see here that he's got gross income, he's got various expenses, so the net profit from his business is $29,750. So that value is transferred over to Schedule SE on line 2. Now, if you're filling this out, you have optional methods to calculate your self-employment tax. So there's a net farm optional method, and then there's a non-farm optional method. We're not making either of those elections. I do have some sample videos on why you would do a non-farm election, but that we're not taking that approach in this example here. So line 2, we've got the net profit from his Schedule C business. And so on line 4A, we start the calculation by multiplying line 3 by 0.9235%. So 92.3% is the $27,474 figure. Now, we don't have any of these items that apply, right? So no conservation reserves. He's not a church employee. So 4B and 5B can remain blank. So the net amount that we're looking at here to test against the $160K limit is $27,474. Now, the maximum amount of combined wages and SE earnings subject to that Social Security tax is the $160,200. So we've got that entry there on line 7. And now on lines 8A through C, we input into the computation how much income we've already recorded that was subject to Social Security taxes. So John's box 1 wages of his W-2 was $140, so he's got that listed there on 1A. But on the Schedule SE, he inputs the box 3 wages from his W-2, which are the Social Security wages, and that's $145,000. And so remember, he's not going to pay Social Security taxes on anything over $160,200. So he's got $27K up here, but not all that is going to be taxed, just the difference between these two. So the 145 minus 160 leaves us with line 9, $15,200. So line 10 asks us to multiply the smaller of line 6 or line 9 by 12.4%. So the smaller value here is line 9. So we multiply 15,200 by 12.4%, and we're left with 1,885. What this does is it effectively taxes only the difference and not the full amount of that net Schedule C earnings subject to self-employment. So we've got the 1885. Now we take the Medicare portion. So we multiply line 6 by 2.9%, and we're left with $797. Add the two together, we get $2,682 of self-employment tax. And then the deductible piece of that self-employment tax is 50%, or $1,341. So now that we have these values, we transfer that to Schedule 2. We transfer the deductible portion to Schedule 1. So if I look at Schedule 2 here, we can see on line 4 my $2,682 of self-employment tax. And then on Schedule 1, page 2, line 15, we have the deductible portion of that SE tax. So once the totals from Schedule 1 and 2 are completed, Schedule 1, we input those adjustments here on line 8, so we can see the total amount of self-employment tax or self-employment income coming through from Schedule C. And then again on Schedule 1, line 10 from Schedule 1, line 26, we have the deduction for 1/2 of that self-employment tax. And then the actual self-employment taxes on our earnings, $2,682 is reported on line 23, right? And that's coming from Schedule 2, line 21. All right, so that covers it for this tutorial. I hope that was helpful. Again, it's really important to remember that if you have any kind of Schedule C income, or if you have income passing through from a partnership, which is line 1 ordinary income or guaranteed payments subject to self-employment tax, you need to factor in any other W-2 wages or unreported tips, right? These types of things that are also subject to Social Security taxes, right? Make sure you're not overpaying above the yearly cap limit. All right, so thanks for watching. I hope that was helpful. As always, I appreciate you watching the videos, and I look forward to seeing you again on the next one. Thank you.